Welcome back, Accounting 604. We are now in video number 5 of Module 6, and we continue to look at certain dispositions of PP&E and how to analyze and account for them. We're now looking at 3 things that can happen, a few of them perhaps rather infrequently, but things for analysts to really consider. As you can see in the slide, we are looking at PP&E, sales, impairments, and restructuring. So let's take these one at a time. You can see that from time to time, an organization may choose to sell some of its assets. And so you can see here, when you sell an asset as an organization, you may realize a gain on the sale, or you may realize a loss on the sale, and those need to be accounted for. And so you can see here, the gain or loss equals, at least from an accounting perspective, what are your proceeds from the sale, how much do you sell it for, and what was the net book value of the asset when it was sold. Net book value, as we determined in the last deck regarding depreciation, right? Net book value is acquisition cost less whatever the accumulated depreciation is at that time. And when the asset is sold, both the acquisition cost and the related accumulated depreciation are removed from the balance sheet, and then any gain or loss is reported on as income from continuing operations. An example of this you can see here in the footnote from Macy's 2022 statement, gains on sale of real estate. The company in 2022 realized $89 million in gains associated with sales of real estate as compared to $91 million in sales, gains in sales sold the year previous, 2021. The 2022 asset sale gains mainly consist of gains from the sale of 6 properties versus 18, 3 times as many properties sold in 2021. And so, as you may be aware, Macy's, one of many large chain retailers that are trying to figure out how do they remain relevant and competitive in the changing retail landscape. One of the ways that Macy's management has decided to try to stay competitive is to offload assets. Well, we might look at assets, especially real estate, as assets, perhaps locations and malls which are no longer performing well. And so rather than stay in it with this large asset base, they are selectively choosing to sell off locations that they feel is just not worth the effort or yielding the kinds of returns that management wants to see. As we continue on in this deck, you can see there is another type of occurrence, and this is different than an asset sale. This is an asset impairment. Well, what exactly is an asset impairment? Well, occasionally, market values of PP&E assets may decrease, a decrease in market value. Now, wait a minute, you may see, well, market values fluctuate for long-lived assets all the time. I mean, holy smokes. My home, if I just every single month check the approximate value on Zillow or something similar, it's going to go up and down all the time. Yes, you're correct, and so is the same with large long-term assets that organizations own. However, the test is somewhat different. The asset is deemed to be permanently impaired by the calculation that is illustrated in the box below. And essentially what you're looking at is not necessarily just the market value and net book value. No, you're looking at what is the undiscounted sum of expected future cash flows. What do you reasonably expect as the stream of future cash flows that you can derive from this asset? And again, if you are looking at this from a finance perspective, we are not looking at the discounted present value of those future streams. We're looking at the algebraic sum of those cash flows, undiscounted. And therefore, if you add all those future cash flows together and that sum is less than the current net book value of the asset is written down to fair market value. Now, realize what I've just said there. Let me slow down. If you recognize and this is why it is pretty rare, that the sum of the undiscounted expected cash flows in the future is less than the current net book value of the asset is impaired, and you must permanently write it down to fair market value, which is a different number than the sum of the undiscounted expected cash flows. Okay. Now, if it doesn't pass that first test, you can see the decision tree here. There's no asset impairment. Now, the reason why asset impairment is a very rare case is because this test is deliberately lenient, that it really has to be an extraordinary event, and as I would put it, it has to be it's really a sign of there already being blood in the water, and that's the only way you get to the point where all these future cash flows is less than the net book value of the particular asset. So very rare, and typically a trailing indicator of problems that you as an analyst have already seen in this company. You can see here then a excerpt, an example from CVS. You can see there, during the year ended December 31st, 2021, the store impairment charge relates to the write-down of operating lease right-of-use assets. And again, what is a right-of-use asset? That's essentially the lease alternative to owning your PP&E. You lease it and have the right of use. Those assets, property and equipment, in connection with the planned closure of, look at this, you may remember CVS closed 900 retail stores in the time span 2022 to 2024. And you see the note here on the slide. As operating cash flows declined at CVS stores nationwide, again, this is also an industry, the retail drugstore industry, that is trying to find relevance, right? Company management determined to close a lot of retail locations, and it was unlikely that these locations would generate enough cash flow to absorb the cost of the operating leases and PP&E assets. So consequently, the facilities were deemed to be impaired permanently, and the assets were written down to their fair values, resulting in a summed expense of, well, look at that. That's basically $1 billion in impairment. Okay, so this is something that an analyst would have already been aware of. The talk would already be out there that CVS and this industry was having enormous problems justifying the large retail footprint of individual stores it was trying to maintain. And so the way that management decided to deal with it from an accounting perspective is to impair and to close all of these retail locations. The third type of event that we are looking at, we looked at sales of assets briefly. We've just looked at impairment of assets. Now we look at corporate restructuring. You can see here corporate restructuring, a third type of occurrence, different than impairment, different than selling assets. Restructuring is designed to turn a company or a division of a company around, frequently initiated in response to poor performance or mounting debt or shareholder pressure, and it can involve all sorts of things: eliminating entire business segments, selling major assets that were once perhaps staples of the organization, downsizing the workforce, reconfiguring debt. And all of these things essentially, right, is with the goal to improve the long-term prospects and hopefully long-term financial performance of the company, to really restructure it in a way that you can turn things around. There are a number of companies that come to mind that have gone through these kinds of things, everything from, for instance, the music retailer Guitar Center, to there have been several restructuring attempts at Sears stores that frankly have not seemed to have worked. But when a company, a large-scale company, is in trouble, these are the kinds of things that a company may try to embark upon to turn things around. And so you can see here the disclosure of restructuring costs from an accounting perspective. Typically, because of their magnitude, restructuring costs being very large, restructurings require enhanced disclosure, either as separate line items in the income statement or in the footnotes, and you can see that there are typically at least 3 components of a major restructuring, and that is the change to the workforce with employee severance or relocations involved. There are asset write-downs or perhaps asset sales that we talked about initially, and all sorts of other restructuring costs. These have to be identified and specified. So if you're talking about changes in the workforce, employee severance or relocation, you can see here the company must estimate the total costs of terminating and or relocating selected employees and report that total estimated cost as an expense and a liability in the period the restructuring program is announced. And if you are instead talking about asset write-downs, which may be closing locations, right, or moving operations to other locations, that might involve a write-down if the fair value is less than book. And you can see some of the types of assets that might be affected, everything from PP&E to intangible assets like goodwill, which we will touch on in another deck towards the end of this module, or even inventories may have to be written down for various reasons. And so write-downs, realize it's a book change. It's a accounting change. It's not a cash flow change, right? It is simply not necessarily, right? If we're talking about write-downs of asset value, that's an accounting change that doesn't really have a cash flow effect unless it involves future tax implications, perhaps tax level of tax reductions. An example that we find in the text is Pfizer's restructuring throughout 2022. You may remember 2022 is when the bottom fell out in terms of their gross profit margin, profitability, revenue, for a number of reasons that we've talked about in previous decks, right? So they made several organizational changes. They sold off some subsidiaries, and the following summarizes Pfizer's cost reduction productivity initiatives. You can see the very large amount of employee terminations represented there, right? Asset impairments as well as exiting from particular markets and restructuring charges, right? And so essentially $882 million of restructuring expense in 2022. Now, when you look at that from an analysis perspective, what you are really trying to get a sense for is the managerial wisdom. If that is the amount of money that you are expending for your restructuring, what will that restructuring yield in the coming years? Is it worth the short-term pain in order to really set the ship aright in the long term? Some insights from these 3 things: asset sales, asset impairments, and restructuring. Asset sales, they could be a strategic tool, right? You could say, look, my capital footprint needs to be adjusted and redeployed to focus on higher return areas. And so that's pretty common and very frequent. If management is on their game, they are constantly looking at ways to redeploy capital resources in a fashion, in a footprint that yields the highest return for the sake of shareholders. Number 2, impairments. Impairments, that's something entirely different. Impairments are relatively infrequent and are typically always lagging indicators of something that has gone seriously wrong that you should already be aware of as a savvy analyst. Already there has been blood in the water. The impairment simply confirms problems that you already know about. It may have no direct cash impact. It should rarely be a surprise. And finally, the third event we've talked about, restructuring. It can be common, especially in larger firms. And this will typically signal management's proactive intent to reset cost structures. And the only question there from an analysis perspective, or the biggest question, right, will the short-term pain yield long-term savings? And will this really be borne out? Well, that's a look at 3 kinds of occasions: sales, impairments, and restructuring, that you will see from time to time in the financials, things that we have to be aware of and understand how they are somewhat similar and how they are very, very different from one another. Hope that's helpful. We'll see you in the next deck.